Hello, welcome to this Chapter 1 overview video where we'll take a look at the first chapter in our financial accounting class. So each chapter, I'll prepare a video like this to show you the most important concepts in each chapter. So there are going to be other videos that we'll mention as we go along, which will help you learn some of the more technical concepts. But for now, we're going to have just what are the most important things in this chapter. All right? So when you're done studying this chapter, you should be able to explain why accounting is important and list the users of accounting information. Describe the organizations and rules that govern accounting. Describe the accounting equation and define assets, liabilities, and equity. Use the accounting equation to analyze transactions and prepare financial statements. Wow, that sounds like a lot, right? So these first 4 chapters in your text cover the foundation of everything else that we're going to study in this course. So I cannot emphasize enough the importance of really mastering the material in this chapter and then the next 3 chapters. Okay, take the time to really understand this stuff and the rest of your semester will be so much easier. If you don't really understand what we do in chapters 1 and 2 in particular, 3 and 4 are going to be really difficult and the rest of the course will be difficult. All right, so commit to the time that you need to really learn this stuff. So why is accounting important? Well, a lot of people think that accounting is boring. It's black and white, it's right and wrong. But accounting really involves a lot of judgment. So economic activity occurs. Think of things like a company buying a new building. There's a million other examples, but what happens is accountants use judgment in accounting for the transactions. They provide useful information to make good decisions. So you are going to use accounting information in your life, and so are many other people. And having the good information enables you to make good decisions, and that leads to a prosperous society. So very, very important. So decision makers use financial statements and other accounting information to make decisions. Now, who are these decision makers? Well, you are one of them. You are going to go off to work and open a 401k. You're going to have to decide where to invest that money, right? You are going to go to work for a company. Hopefully you're not going to go to work for a company that's going to go bankrupt. So hopefully you'll look at their financial statements and you'll see, all right, this looks like a safe bet. Or you might buy a condo, right? If you buy a condo, you have to make sure that the condo is financially sound. Otherwise, you know what happens? They don't have enough money to pay for things and you get giant assessments, meaning you have to pay a lot more money than you had planned to pay. So you will be using accounting information. Businesses use accounting information in the same way. They use it to decide who to sell to. They use it to make sure that their suppliers are sound. Investors use accounting information to decide, well, do we want to invest in Coca-Cola or PepsiCo, right? A classic example. And then we have creditors. Creditors are deciding whether or not they're going to lend money to a business. You will have creditors, right? They're going to decide whether or not they're going to lend you money. What is that going to be based on? Things like your credit rating, right? Finally, taxing authorities use accounting information in order to make sure that companies are paying their fair share of taxes. There is a huge demand for accountants right now. There are not enough of them. The careers are more and more exciting. Back in the old days, we did used to have to add up a lot of numbers, but nowadays the computers do a lot of the grunt work for us. And so the work that accountants do is more exciting than ever. There's a lot of analysis, and computers are extremely important. Public accountants are people that work for accounting firms, and they go into other companies to either advise them, help them to prepare their taxes, prepare an audit to make sure their financial statements are representative of what really happened in the company. Many public accountants get the CPA designation, which is the Certified Public Accountant. That helps open a lot of doors for you. It is required for some jobs. So if you're studying accounting, I would highly recommend that you think about becoming a CPA. People who work in private accounting, they work within one single company. So you might work within, say, an IBM or a PepsiCo, and you might be doing accounting within that company. Some people who work in private accounting get the CMA, which is the Certified Management Accountant. We're going to do a little accounting career assignment in Chapter 2, where we're going to take a look at what some of the accounting careers, or what some of the possibilities are in accounting careers. So who are the organizations and what are the rules that happen in accounting? So the rules are called GAAP, which is Generally Accepted Accounting Principles. The rules are made by the FASB, Financial Accounting Standards Board. Their headquarters is right nearby. It's right in Norwalk, Connecticut. And the SEC oversees the financial markets. You're probably familiar with the Securities and Exchange Commission. They are the ones that oversee the stock exchanges and a lot of other financial matters. All right, so the rules that govern the preparation of financial statements are made by the FASB, the Financial Accounting Standards Board, and they allow for comparability among financial statements. So all the companies are following the same rules, and that's why you can open Coca-Cola's annual report and you can compare the numbers to Pepsi because they use the same rules. All right, here's one of your BFFs. It's called the accounting equation. This little equation on your screen right now is true of every business, every moment in time. And it's also probably true of you. Let's think about this. You have some assets. Do you have some money? Do you have a computer? Where did you get them from? Did you borrow money to get them? Or did you earn the money to get them? That's the same thing that happens with companies. So companies' assets either come from borrowing or they come from equity. And the equity comes from two places: people contributing money into the company as investors, or money that the company earned. So let's expand this equation a little. We know what assets are, right? Things like cash, equipment. Liabilities, money that the company owes to somebody else. Contributed capital is money that has been contributed or put into the corporation. So we're talking about corporations here. And if, say, you decided to start a new business as a corporation and someone invested in your business, you would give them common stock. And when they give you the money, you would have common stock in your financial statements. Now, why do people invest in companies? Well, there's a couple of reasons, right? One of them might be to get dividends. And what are dividends? Dividends are distributions of profits that are paid out to stockholders. So dividends reduce your equity. Revenues increase your equity, and expenses decrease them. So think about your own situation, right? If you have money coming in, that increases your assets and your equity. If you have money going out, that decreases your assets and your equity. Okay? All right, so this is really the foundation of everything. And if you are a person who likes like index cards or having notes, this is a very important thing to write down. This has to be memorized. And actually, if you could write the whole thing down, that would be better. Maybe 2 different index cards. There's a lot of research that shows writing physically with your hands as opposed to typing helps you to remember things. All right, so write whenever you can. Okay, so next up, let's take a look at how different transactions affect this accounting equation. So up there on your screen is the accounting equation. And let's see how when the business does particular things, it affects their accounting equation. So let's say a stockholder contributes some money to the company. So somebody invested money in the company. The company's assets go up. Why? The company got cash, right? Its stockholders' equity goes up. Why? It has common stock. Okay? So notice that this, you see this, every time a transaction happens in a company, it has to affect at least 2 items because you have to always remain in balance. All right, so we're in balance right now. Now let's say the company borrows some money. All right, it's getting money, cash, right? So it's getting assets. It's also increasing its liabilities. So it owes money to the bank. It got some cash. Let's say it takes some of that cash that it got from these two transactions and it buys some equipment. Now, I put these both in here because cash is going up. Cash is going down because you're paying out cash, and your equipment is going up. So your assets are going up and they're going down. By the way, in accounting, we use brackets for minus. Don't ask me why. I don't know the answer to that, but that's what we do. When you see brackets in accounting, that means a negative number, okay? So we have a plus 70, a minus 70, no effect really on the accounting equation. Finally, let's say the company earns some revenues. So customers give you $54,000, you have cash, and you have equity. That's the retained earnings. Remember, we said revenues increase our equity. So in the end, we add all of these up, and we see that we have assets totaling $204,000. We have some cash, and we have some equipment. We have liabilities of $100,000, and we have equity of $104,000. These two added together equal that, right? Okay. So obviously companies aren't doing this all day long, of course. In the end, all of their financial transactions for the year are summarized in financial statements. So everything ends up here, okay? All of those transactions. So there are four main financial statements. The first one is called the income statement. And also sometimes you'll hear people say P&L, that's profit and loss. That tells you about profitability, revenues, and expenses. We're going to see what these look like in a minute. Then the statement of stockholders' equity, or the statement of retained earnings, shows what happened to your stockholders' equity accounts during the year. Why did they go up or down? The balance sheet is a snapshot at a point of time. At the end of the period, it says how much do we have left in assets, how much are our liabilities, how much are our equity. That might sound familiar, right? And then the statement of cash flows tells us what happened to cash during the period. So these statements are generally prepared in this order, and they're all interrelated, as we're going to see right now. All right, so we always start with the income statement. So let's look at Finn's Fabulous Fishing Expeditions, assuming that maybe this company takes people out in boats and goes fishing, right? So during the year, customers paid them $267,000. They provided services to the customers. That's called service revenue, and they got $267,000. They paid some expenses, okay? So they paid salaries, they paid rent, advertising, supplies. These expenses are generally listed from largest to smallest, all right? Because we want to see the most important one on top. Add up all your expenses and we get the total here. Subtract it from your revenue and you get net income. Now, a couple things you want to notice. We have a three-part heading. Everything you do in accounting, almost everything, should have a three-part heading. What does it tell you? The name of the company, the statement, name of the statement, and what the period of time is, right? Because if you don't have a period of time, this might have been a month, it might have been a quarter, we don't know, right? So this tells us, okay, this was for a year. Here is one of those magic things that you should write on index cards if you have them. I would get some of those old-fashioned little 3x5 index cards if this is something you have to memorize. The first thing was the accounting equation. This is revenues minus expenses equals net income. Take your revenue, subtract your expenses, you get net income. That's what's on your income statement, okay? So your net income from here goes to our statement of stockholders' equity. So statement of stockholders' equity, it looks a little complicated, but it's not too bad. Again, notice it has a three-part heading, right? The beginning balances here are all zero because this company just began in business this year. Now here are our formulas. Beginning common stock plus any stock that was issued during the year. Issuing common stock means that people contributed money to the company. Add those two together and you get your ending balance at the end of the period. Your retained earnings is exactly what it sounds like. It's earnings, income, that are retained in the company, not paid out in dividends. So our retained earnings are equal to beginning retained earnings plus net income minus dividends. That's where we get our ending retained earnings. Now, again, this is another formula that you have to memorize. Write it down, stick it on an index card, carry it around with you. Test yourself to make sure that you know it. So now the net income here, again, we said it came from the income statement, right? And then these totals here, we're just adding across. So these are zeros to 50, plus 0 gives us 50. Adding across, adding across, adding across. Okay, that's where you get those totals. Finally, we have, nope, not finally, we have two more. We have a balance sheet balances. Notice these two numbers. This is really, really important. Really important. A lot of times students start a balance sheet and they don't finish it, or they have a balance sheet that doesn't balance. Notice what's on the balance sheet. It is our friend, the accounting equation. So remember what happened. Finn ended up with $134,000 in cash. We'll see where that came from in a minute. Remember, the company bought some equipment, so its total assets are $204,000. This is as of a point in time. Notice it doesn't say for the year ended. It's at the end of the year, so it's on December 31st. Remember that the company borrowed $100,000, and notes payable means that you borrowed money from a bank and you signed a note and you said, I'm going to pay you back and I'm going to pay you some interest, and then there's a due date, right? We'll look at that in more detail later. Common stock is the money that stockholders contributed to the company, and then remember the retained earnings in this case is just net income because we didn't pay any dividends. Again, very, very important here, right? These two numbers have to be equal. Okay, finally now we have the statement of cash flows. Now the statement of cash flows shows where cash came from and where it was spent. So for Finn, they got $54,000 from their customers. They spent $70,000 buying equipment. That's an investing activity. Then they financed the company by issuing common stock. So remember, the stockholders contributed $50,000 and they borrowed $100,000. So $150,000 came in from financing. They used it $70,000 to buy equipment, and then they got $54,000 from their customers. So they ended up with the $134,000. The formula for statement of cash flows is that operating activities plus or minus investing activities plus or minus financing activities gives you your increase or decrease in cash. So this year our cash increased to $134,000. Our beginning cash balance is 0 because this is the first year of business. This ending cash balance equals the ending cash balance on our balance sheet. Okay, the $134,000. All right, that's all I have for this chapter. Remember, there's a couple of videos. There's one about analyzing transactions. There's some financial statement videos. Make sure you watch those. Use all the resources that you have. And remember that this is the foundation of everything else, this chapter and chapter 2. Okay, see you next time.